Hi, everybody. This is Dan Sheridan from Sheridan Risk Management. Monday, January 27th, a wild day. Um, we had today, we were down 1.5% in the SPX at 60.12. You can look at my chart here. We had a low of 59.62. At one point, we were down almost 2% with all the kind of AI news out of China. I mean, uh, VIX was near 20 and it backed off a bit, up 3 points for the day. But you had a huge move today. Starting Wednesday afternoon, a lot of catalysts to get the volcano erupting. You've got the Fed and the FOMC coming out. Um, Tuesday starting at 2 o'clock. You've got Microsoft, Tesla coming out earnings after the close. Thursday, before the opening, advanced GDP initial claims, continuing claims, that's pre-market. And then after the close Thursday, Apple, Amazon earnings. What does that mean for range-bound trades? It means a little pandemonium. And throw on top of that, put a little extra sauce on the fire. Look at this. You're the last 7 or 8 days in the SPX, basically roller coaster at Six Flags, straight up. And so, what does this have to do with range bound trading? Not a whole lot, right? But you say, okay, for a range bound, obviously in this environment, I'd be very small. Again, I like to look at trades. What is the market? Is it giving us anything? And the only thing that I might consider is, okay, what would I be comfortable that can handle quite a bit of price move and take advantage of the fact that we're up 3 points in VIX today? And the answer would be some kind of short Vega trade. So I'm going to just throw out a couple ideas for you, even in this volatile environment. You say, Dan, if it's range bound, wouldn't you just sit out till Friday or something and let some of these catalysts play themselves out? We're not really range bound right now. Yeah, that would be the most conservative approach. But I think it's good to go over on a daily basis. What's the market giving you? Okay, with the price, the VIX, how the market's moving, plus news, that's what we look at, what you'd be comfortable with. Here's a couple ideas. Number one, number uno. Let's start with a put vertical credit spread. What does it mean when the VIX is up versus when VIX is low? The range for VIX for the year, taking out a few days in August when the Japanese craziness was going on, the basic range is about 11 to 21, the normal range. So we're at around 18, which is in the higher end of the range. What would I be comfortable with in the middle of a power-packed week that could erupt the volcano? And right now, we're at about 60.12, right? So what if I did a put credit spread? Any advantage of doing put credit spread when VIX is up like this in the upper end of the range? Yeah, you get more room. So this particular credit spread I'm looking at, Feb 21, is 25 days out. So this would be a little over a 3-week put credit spread. And it's giving us about, let's see, the short, just on the put credit spread, 5,800. So you get 212 points on a 25-day spread. I'd be looking to be in this about 7 days or so. Okay, so here's how I look at it. I look at a 7-day expected move like a standard deviation, about 110 points. Can this handle the heat till 5,900? Yeah, you can handle the heat, right? So I'm not holding this to expiration. I'd hold a 25-day trade, about 30% of the duration. So about, what is that? A week, right? And you look at what's the expected move or one standard deviation in a week, and we just looked at it. 7 days, 110 points. We're in good shape, right? So that's kind of the thing. And when you do a put credit spread because of the skew in SPX, I'm 0.73 deltas long with no risk on the upside. Good grief, Charlie Brown. We can work with that, right? Next thing, candidate, Iron Condor. You might say 2 credits are better than 1, right? Iron Condor is going to be less margin or risk than a vertical credit spread because of the 2. But here, you're getting 5,800 on the downside, 6,250 on the upside. How did I construct this one? A little, I would call this an equidistant, relatively equidistant iron condor. Maybe 2 different types of iron condor, kind of the same delta and equidistant. Equidistant would be, all right, we're at 60.12 in the SPX. Our short call is 62.56. It's about what is this about 240 points up our short call. It's a 3.5 week expiration till Feb 21. And our downside is about 212 points. That's not exact, but it's close enough. Equidistant, if you look at the expiration graph, relatively equidistant. So that's going to get you relatively close to 0, minus 0.37 delta short. On this is 25 days out. I'm choosing my short strike with maybe the calls, about a 12 delta, and the puts a 20 delta. That's what I need to get the deltas around here. Those are spreads, and I want to bring up this concept to you. A lot of you may not have heard that gamma. One of the main things to handle range-bound trades in a volatile environment is to have a low gamma. So here's a gamma of minus 0.01. Low would be minus 0.01, minus 0.02. That just means if we go up 2% or down 2% in SPX, which would be about 120 points, the deltas change very little. How does that impact me if the deltas change very little? You lose very little, right? You can handle the heat, right? It's like driving a Hummer in the snow in Chicago. So those are 2 trades. There's other trades, but low gamma trades, right? That, minus 0.01, this shows minus 0.00 for the put credit spread, but it's not, but that I'm comfortable with. Now, couple things. We've got an exciting course starting next Tuesday and Thursday. Starting Feb 1, it'll go every month, Feb, then March, then April. And the idea is called 10% class. It's kind of patterned after some of our popular classes in the past. A plan to make 3K and 25K, a plan to make 10% per month. This is going to be 10% a month. I'm going to use $10,000, a reasonable number for everybody. Every month, I'm going to start at Feb 1, and we'll run it every month. I'll put 2 or 3 range-bound trades on, occasional spec trade, but 2 or 3 range-bound trades on, and we'll go through it. Every trade, every adjustment you'll get, but more important, you'll get what the heck is he doing? Why is he doing it? Right? So it's an alert service with teaching, right? My goal never has been alert service, it's been teaching people the craft. So this is a great opportunity for you to learn the craft. Jump in next Monday, that'll be Feb 3. We'll go through Monday. And our goal is to make 10% a month on the capital of 10K. The class will be $147. You can continue on, see March, April if you want. You don't have to continue on. If you're interested, just send an email either to dan@sheridanriskmanagement.com or support@sheridanriskmanagement.com. We can help you if you have any more questions or anything like that. But we're excited about it. Everything will be documented, so not only can you participate, but you can watch, and you can get, most important, taking the mystery away. What is he doing? So you'll learn the craft. Join us next Monday. Again, send an email either to support@sheridanmanagement.com or or Dan@sheridanriskmanagement.com. We would be thrilled to have you join us next Monday. Have a great day, everybody. We'll see you later. Thanks.